Good afternoon, everyone, and welcome to today's webinar, Due Diligence Best Practices on Private Placement Investments While Using a Self-Directed IRA, presented by Next Generation and Syndication Attorneys. I'm Erica Figueredo, the marketing specialist here at Next Generation. And before we get into today's discussion, I wanted to review some housekeeping items, give you some information on our speakers, and tell you a bit about Next Generation. So as always, today's session is being recorded for anyone who didn't have a chance to make it live, and for those who wish to watch today's session again. If you're here with us live, it's great to have you, and everyone joining today will be on mute for the entirety of the session, but that doesn't mean that we don't want to hear from you. So I'd like everyone to take a moment to find their GoToWebinar control panels, which should appear on the right-hand side of your screen if you're joining from a desktop. So the two main features that I want everyone to pay attention to is the questions tab and the chat tab. So if you have any questions during today's session, please use that questions tab. Otherwise, conversations, feedback, anything else can go into the chat tab. That's also where I'd like you guys to just take a moment, introduce yourselves, let us know who you are, where you're from, what you do, and what brings you here today. So to tell you a bit about our speakers, first and foremost, we have our expert co-host, Kim Lisa Taylor, the founder of Syndication Attorneys. Kim, give a wave. Thank you. Kim is a nationally recognized corporate securities attorney, speaker, and the #1 Amazon best-selling book, How to Legally Raise Private Money. As I said before, she is the founder of Syndication Attorneys, PLLC, along with InvestorMarketingMaterials.com, whose purpose is to provide quality legal advice in plain English, offering documents and professionally designed marketing materials for clients nationwide. Kim has been the responsible attorney for hundreds of securities offerings and is listed in the 2020 Top 100 Attorneys and Top 100 in Finance magazines. Last but not least, we have our very own Scott Ritchie, who is Next Generation's business development rep. Scott brings a wealth of experience to his role with the sales and marketing team at Next Generation, where he focuses on business development for the company. He has more than 10 years of experience in the sales arena, including 7 years in financial services, where he worked extensively with both group and individual retirement plan accounts. Scott has also worked in operations as well as marketing, media, and public relations, all which serve him well and bring diverse perspectives to his current role with Next Generation. Scott is a graduate of the University of North Carolina, Wilmington, where he earned a BA in English and also earned a film and video production certificate from New York University. In 2007, he received his Life Underwriter Training Council Fellow, also known as LUTCF, designation from the American College of Financial Services in Bryn Mawr, Pennsylvania. Scott, who is married and has 2 sons, resides in Somerset County, New Jersey. So now to tell you guys a bit about Next Generation. So Next Generation is a custodian and administrator for self-directed retirement plans. So these plans are much like the plans you would find at a brokerage like Fidelity or Charles Schwab, the only difference between the two being the types of investments that can be held within them. So instead of investing in stocks, bonds, or other publicly traded assets, self-directed IRAs give investors the opportunity to hold alternative investments which are non-publicly traded, within a tax-advantaged retirement vehicle. So this includes real estate, private equity, notes and loans, or other types of lending, cryptocurrency, precious metals, and a lot more. These accounts provide a hedge against stock market volatility. They allow investors to diversify their retirement portfolios, and they give them better control over their investment returns. So there are 2 main arms to our business. The first of which is the administrative arm and our headquarters, Next Generation Services, which is located in Roseland, New Jersey. Next Generation Services handles all of the back office administration, record keeping, mandatory tax reporting, and transaction support for all of our client accounts. Next Generation Trust Company, located in Sioux Falls, South Dakota, is a licensed chartered trust company serving as custodian for all of our accounts. And all of our accounts are named with Next Generation Trust Company as the custodian and holder of all assets for the benefit of the individual account owner. So now, just to give you our very necessary disclaimer on what we don't do, before I hand it off. Next Generation is not a bank or fiduciary, so we do not provide any financial, tax, or legal advice. We also don't endorse, recommend, or review the merits of any investment. So any information provided during today's webinar is for educational purposes only. So now to hand the floor over to Scott to drive our conversation. Scott, take it away.
Thank you, Erica, and thank you everybody who is joining us today. Kim, it's a pleasure to have you. So without further ado, I guess we'll just dive right in here. We'll start with a very basic question. What is a private placement?
So it's that's a kind of a loaded question, but it's really an opportunity for people to invest in alternatives to traditional publicly traded companies, stocks, bonds, annuities, and those kinds of things. So it gives people an opportunity to invest in small businesses with people that they know or that they've developed relationships with, who are usually I think the most widely used aspect of it that I'm involved in is real estate offerings. So people who are putting together a commercial real estate transaction and they want to bring in private investors who will passively invest with them. While there's a group of people within management who are going to be, finding the assets, conducting due diligence, and generating the offering documents for those investors. So the offering documents there's multiple documents that the investors would get to be able to invest in one of these private placements, and one of them is called a private placement memorandum. Another is called a subscription agreement, and then there's going to be some kind of an investment vehicle, whether it could be a promissory note or an LLC operating agreement, so that the investor is actually buying interest in a company. So that's kind of in a nutshell, what the private placement is all about. It's a securities compliance document. When people are selling private investments, they're usually selling something called an investment contract, where the investor is relying on the people who are promoting the offering to generate the profits for them. So that's called an investment contract. And when someone is selling an investment contract, those are securities. They fall within the definition of securities in the Securities Act of 1933. And then that triggers all the securities compliance, which is where they then have to provide all the material facts the investors need to make informed consent. And that's what the private placement memorandum is designed to do. It's to provide all that information so the investors can read all about the offering, what it is they're investing in, are they buying interest in this company, how much do they get, how are they going to get paid back their money, how are they going to get paid a return on that investment, how long might their money be invested. All of those things are discussed within the private placement memorandum, but most importantly, it talks about the risks of the investment, what it is that that could go wrong. The real estate market could change, laws could change, all manner of things that could happen that could affect that investment for the period of time that it's invested. So that's what the private placement memorandum does, is it talks about all those things so that the investor can read that, decide if those are risks that they're willing to take, and if so, then they can go ahead and make that decision that they want to invest.
Oh, okay. That's really good information. Now, what would the qualifications be for a person who wanted to invest in a private placement?
So when somebody's putting together one of these deals, then they're going to be selling securities. They know they're going to have some passive investors. then they either have to register the offering, and that means getting it pre-approved by a regulatory agency. So there's securities agencies both at the federal level, that's the Securities and Exchange Commission, but then every state has its own securities agency. So if everything is contained within one state, then maybe that we call them a syndicator, that person that's putting that deal together, maybe that syndicator is following some state securities regulations. So they would either have to get pre-approval from these regulators, or they could qualify for an exemption from registration. And so there's different exemptions based on if everything's contained in one state, they might be following that state's security exemption, or if they're going to be crossing state lines, buying properties where the syndicators don't live, and bringing in investors from multiple states, then they would probably choose to follow the federal rules. And so these federal exemptions each have a very specific set of rules. The one that most commonly people use is called Regulation D, Rule 506. And Rule 506 has two parts, so that you can choose one or the other. So Rule 506B is one that allows the syndicator to put together a group of investors. They don't have to count the number of accredited investors they have, and they could have up to 35 non-accredited but sophisticated investors. And so that's kind of where your self-directed IRA clients come in, is that they usually fall within that category of well, not usually, but some of them may fall within that category of non-accredited, but because of the training that either you've given them or they've gone out and learned on their own, they've gone to some real estate seminars, things like that, they've become sophisticated enough to be able to invest in these deals. And so they could invest in this Rule 506B offering, but they have to develop a pre-existing relationship with the syndicator first. And so, you kind of have to go out and meet those people before you're able to invest in their offerings. So, the qualifications, so for 506B, you could be accredited or you could be non-accredited but sophisticated. If somebody was doing a 506C offering, then they would be able to freely advertise that offering. It wouldn't require a pre-existing relationship. But the only people that could invest in that would be verified accredited investors. So if you were an investor that's going to invest in a Rule 506C offering, you would have to prove through providing your financial statements or your income statements, you would have to show those to somebody who would certify that you met the qualifications as accredited. We can talk about those definitions of accredited versus non-accredited and sophisticated if you think that's of interest, Scott.
Yeah, I think it'd be great if you could address that.
Yeah, absolutely. So an accredited investor is someone who has over $1 million net worth, excluding any equity in their primary residence, or they have over $200,000 a year income if they're single, or $300,000 a year income if they're a married or married couple or spousal equivalents. Also, there's a definition of an accredited investor of people that are putting the syndication together. So we're calling this a syndication. When someone is buying real estate and putting together this group of investors, we're calling this a syndication. And the people who are organizing it are the syndicators, and of course the people who are investing in it are the investors. Yeah, that would be the accredited investor definition. That has to be for the past 2 years that you've met those qualifications, and with an expectation that will continue indefinitely. For the non-accredited, that's everybody who doesn't meet the accredited definition, but in order to be sophisticated, the investor has to have the financial, educational, or one or the other background that would make them capable of understanding the merits and risks of that prospective investment and understanding whether it's appropriate for their portfolio. And they can do that either by themselves or with the help of an investment advisor. So if somebody has an investment advisor that gives them advice on what things they should or shouldn't be investing in, they could meet that sophistication requirement by having that person review the offering and decide whether it's appropriate for them. or they could be sophisticated on their own just because they've gone out and they've educated themselves, or they have some past real estate investment experience. Maybe they've heavily invested in the stock market before. Sophistication is something more than just somebody with a self-directed IRA account and a job, right? That you've got to go out and kind of be proactive about becoming sophisticated if you want to be able to invest in these kinds of offerings.
Okay. Now, early on, you had referenced the PPM, which is a private placement memorandum. Can you expand on that a little? Is that something that gets created by you as the attorney, or do you work with the person doing the private placement?
So the offering package itself consists of several documents. So usually when a client comes to us and says, hey, we have a deal under contract. So a lot of our clients are buying multifamily properties. So they'll go out and they'll get a purchase agreement on a property signed by the seller, and then they'll conduct some preliminary due diligence just to make sure that the deal makes financial sense. And then they'll go and visit the site and they'll conduct due diligence and all of that. Well, they'll come to us early on in that process, and they'll say, okay, we want to raise money from private investors. Can you help us draft the appropriate documents and structure this deal correctly? And so at that point, we'll have an initial call with them, figure out what they're trying to do, what they want to offer investors, and figure out what documents have to be created. But a very typical syndication offering package would be the private placement memorandum that we talked about before. And so that's the one that's describing how the offering is structured, who's in it, what are the risks, all of those things. And all of the financial aspects. When are the investors going to get their money back? When are they going to get distributions? How are they going to make money on this deal? So that's the private placement memorandum. Then we would create usually an LLC that's going to take title to the property and going to sell off part of the interest to the investors. So let's say somebody's going to sell 70% of the company that's going to own the property. They're going to sell 70% of that to the investors for 100% of the money that's needed for the down payment, the closing costs, any capital improvement costs, their upfront legal fees, and any capital like reserves that they need to keep. Maybe the lender's going to require something, or they're going to just have some money in reserves in order to make sure that they don't go bankrupt. So that's the operating agreement. Then there will be a subscription agreement, and a subscription agreement is where the investor tells the syndicator about themselves. So this is where they certify to the syndicator that they've read all of the documents the syndicator provided, they've asked all the questions, they've got whatever legal or financial or accounting advice they thought was appropriate and necessary. They understand the risks, and they can afford to lose the money. It wouldn't be devastating to them if they did lose the money. 99% of the deals go well, but there are some that just don't prosper. So you've got to be willing to take that risk. So that's the subscription agreement. And also they would talk, the subscription agreement is where the investor would say, yes, I meet the qualifications for this investment. For a Rule 506B offering, the investors can self-certify that they meet the qualifications either as accredited or non-accredited, and they meet that definition of sophisticated. For the Rule 506C, then they would have to provide a letter from their CPA or attorney or somebody who has looked at their financials and certified them as an accredited investor. But then there's another piece, and this is the piece that the syndicator actually provides, where they talk about the actual investment. So we call that a property package. There's various names for it. Property package, investment summary. It's going to have some pictures of the property. It's going to talk about where it's located, what the syndicator plans to do with it, as far as what kind of improvements are they going to make. They're going to have some 3 different sets of financial projections. Usually, if it's a well-written investment summary, it's going to talk about what money is needed to get into this project, and then 5-year projections for how they see the income and expenses playing out over a 5-year period of time. And that's going to usually include some opportunity for the syndicator to maybe decrease the operating expenses and increase revenue. And they're usually going to increase revenue by improving the property, sprucing it up, maybe doing some renovations on the units or the exteriors, making it look better so that they can command a slightly higher rent. And then for every time that they increase the rent, then they're increasing the value of the property. And so after, they'll hold it usually somewhere between 3 and 7 years. And then after that, they'll sell the property, and then there will be some equity shared. And when I say equity, it's the share of profits that's going to be shared with those investors during the period of time they own the property. So from cash flow from the rental income, and then also when they sell the property, then there would be a profit that's generated on sale because they've been able to increase the property's value. And then that would also get shared with investors. So that's all going to be described in that investment summary or that property package. So that's going to be a really key and important document that the investors are going to want to look at and really understand, and make sure, if you don't understand that yourself, you might want to take it to your CPA and say, hey, can you help explain this to me? Does it make sense? And then after you've seen a few of those, I think you kind of get the idea and understand how to review them. The third table that's usually going to be included in there is some kind of proposed exit strategy of, what the syndicator is just kind of projecting into the future. If we make all these improvements and we're able to increase the rent the way we've planned, then, how much might we be able to sell the property for in the future? And they're going to have to make some assumptions about all of these tables, but it's their best estimate of how the property is going to perform and what kind of returns the investors could expect if everything plays out the way they planned. So that's what kind of your offering package. So the PPM is really the primary document, but all these other things are attachments to it. So collectively, it all becomes the private placement offering package.
There's a lot involved with all of that. And just a little foreshadowing, that is what, as a custodian, we look for when we have people who are reaching out to look to invest in a private placement. Now, specifically, what should an investor be looking for when they want to invest in a private placement? Is there any particular criteria?
You got to look at the people that are doing the deal, right? Look at the syndicators, who's on their team, what kind of experience they have, how well you know them. It's pretty easy to conduct a little bit of preliminary due diligence on people just on the internet, looking up their Facebook accounts, looking up their LinkedIn accounts, and, just kind of developing a general feel for, how you feel about this person. You should absolutely be having live conversations with them. You don't have to sit down face to face and have coffee, but if you can, that's wonderful. At the very least, you should be having one-on-one phone calls or even Zoom calls where you can get to know that person a little bit. I think a lot of us are, maybe us more than other are a little intuitive about people, but I think you get a sense of who someone is when you've had a few conversations with them. But the more you can interact with that syndicator and the people on their team to make sure that you're comfortable that they know what they're doing, that they're going to be safe, safeguarding your investment. These syndicators have a fiduciary responsibility to the investors where they are supposed to put the investors' interests ahead of their own. But you have to realize that the syndicator isn't doing this out of the goodness of their heart. They're also doing it so they can make a living for themselves. And, and some of them who become highly successful at it actually make a very good living for themselves. But it's because of the skills that they develop in making these deals successful that they're able to reap those rewards. If they're doing unsuccessful deals, they shouldn't be getting that much in a reward. So you want to look at how the deal is structured and make sure that the syndicator is getting compensated fairly. You don't want to, honestly, you don't want to invest in a deal where it doesn't look like the syndicator is going to make any money until the property sells. Because in that case, their interests and your interests are going to be misaligned because they're going to have every incentive to sell the property while you're liking, you don't want to sell it because you're making good money off from your share of the profits. And you want to hold on to it longer term. So, look to make sure that they're getting adequately compensated and you know, be comfortable with the amount of money that they're making. If you feel like they're, you know, not making enough, that's a red flag. If you feel like they're making way too much, then that too is a red flag. But you know, you do want to make sure that they're getting compensated and you're getting compensated, of course. You know, look at the projected. There's often going to be some kind of a preferred return during the period of time that you're owning the property, and what that means is that the investors get paid first before the syndicators, up to a certain hurdle amount, and it's going to be somewhere between 6 and 8% is the going rate right now. So the investors would get like a 6 to 8% return on their money, and then the syndicator would be able to then take something for themselves. But if there isn't enough, then the investors would get 100% of the cash until that hurdle rate is achieved. And then later on, when you sell the property, usually there's going to be another hurdle rate that the syndicator is trying to achieve for the investors. They're, you know, trying to get them usually a return that's 15 to, you know, 18%, somewhere in the mid to high teens is the going rate right now. And what that means, it's an annualized return. So you would take the amount that you're going to receive during the period of time you own the property, and then the chunk of cash that you're going to get allocated after the property is sold and the profits are being distributed. And then you would add that chunk of cash, divide it out over the amount of time that the property has been held, add it to the amount that you've already received as a return on your investment. And so those two numbers collectively become your overall annualized return. So if you don't understand annualized returns, that is a term that you're going to want to look up and investigate so that you understand how annualized returns work, so you get a sense of what's being projected. Is it realistic? You know, if somebody's offering you 25 or 30% returns, you know, maybe that's not realistic in today's market. So you want to make sure that what they're offering is realistic, but also make sure that you understand how it works and when you might realize those profits, and then all the things that could happen in between that might make those profits fluctuate from that number.
Okay, so if you were gonna, I guess, then with what you just said, like vet the investments, where is the best part or best place to do your research? Is it online? Is it, you know, through the online search engines? Like, where can you do the research to vet your people you're planning on investing with?
Yeah, online is good. I mean, you could go so far as to hire somebody to do a background check on someone. But, you know, in today's world, if somebody's doing bad things, you're going to find stuff about them on the internet. And, you know, you can ask around. You can ask them for references of prior investors. You want to know how many deals they've done before like this, right? Just because somebody's owned some real estate before doesn't mean that they've owned it with investors. So you want to know how many deals have they owned with investors, and how are those deals working out? And you know, you should, don't necessarily shy away from somebody who's had a bad deal, because one thing, if they're telling you about it, that means they're being honest. And not every deal is a great deal, but most of them work out well. So, you know, I would do some internet research if you want, you know, feel comfortable asking them if you can do a background check. You can certainly ask. It would be interesting what they said. If they said no, then maybe you don't want to invest with them. If they said yes, then you know, maybe that's less of a concern. But you know, I don't think that most passive investors do background checks on the people that they're going to invest with. I think more of them should do at least some internet investigation on their own to see what they can find out about that person.
So I guess my final question for you, Kim, would be, if I wanted to do this, should I hire an attorney to review other people's offerings?
You can. We've done that for other clients in the past, as long as it's not somebody that we've done an offering for. You know, that would be a conflict. But if it's somebody that we don't know, you know, that we haven't done an offering for, we can look at the documents to see if they're compliant with securities laws. Make sure that they have the right clauses, point out some things that might be red flags. You know, maybe another red flag is that if you can't remove a manager. right? So if you can't remove the syndicators as your management team, what if they're just not doing the job? There should be a way for the investors to be able to vote and get them out, but it's not going to be like just a simple majority vote. It's probably going to be a little higher hurdle than that. But if enough people think they're doing a bad job, there should be a way to remove them. My book, I have actually written a book called How to Legally Raise Private Money. The last chapter in this book is written for investors, and the whole book really is valuable to investors because it explains how the syndication process works start to finish. And it's an opportunity for the investors to learn what the syndicators should be doing. And once you understand the process of syndication yourself, you're going to be a much more educated investor and a more sophisticated investor, so that you're going to be able to make decisions about that investor. But there is a chapter in the back that just says, 10 things you should look for before you invest in a syndicate. And that book is available. You can get a digital copy free at our website if you're interested, or you can buy it on Amazon. But I just think I wrote it as a resource, so it could be a reference for both people who are syndicating and for people who are investing in syndicates.
Okay, and I guess I was wondering what states do you practice in? It might have been in your bio, but just to refresh everybody's memory.
So
What
I'm
state
actually licensed. I'm licensed in California and Florida, but most of our clients are doing federal offerings, so we're able to help them in any state.
Okay, great. Well, I appreciate the conversation on your end. Is there any questions you have for me?
Yeah, I do. So, we get a lot of questions from our clients about how to process investors that want to invest through their IRAs. So this is a great opportunity for me to ask you some questions too. So what does the IRA custodian have to do if someone wants to invest in a private placement?
Well, first off, you got to open an account. So if you're interested in investing in a private placement and you reach out to a company like Next Generation, the very first step is to fill out an application and submit it for approval. Once the application is received, we take a review of it. We make sure everything's in order. And when the account is approved, we hand off to our transaction team. Our office is 2 divisions, sales and marketing and transactions. Once we hand off to our transaction team, the transaction team will then work with the investor in getting the money moved over. We have a number of retirement plans. We have IRAs, we have simple IRAs, we have solo Ks, we have SEP IRAs, we do Coverdales, we do a lot. So there's a lot of opportunity to invest using a self-directed vehicle. Once we get the money moved over from however it's coming, or if we're setting it up ourselves, then we get the proper documentation needed. You alluded to a bunch, the subscription agreement, the PPM, et cetera. We do a compliance review of that, which generally takes 2 to 5 days. And once that is done, then we are ready to move forward and execute the investment. So that's sort of how the process works from soup to nuts.
That's great. Yeah, so it sounds like you guys really kind of cover all the bases. And I think a lot of people need that because they don't really understand what a self-directed IRA is and how it works. So I'm sure that your team is able to educate them about that. So I've heard that there are certain prohibited transactions with respect to an IRA investor that's investing in a private placement. Can you talk a little bit about those?
Well, there are a prohibited transaction is obviously something that you don't want to engage in because it could lead to distribution of the IRAs or the retirement. So obviously the problem there is whatever your investment is, whatever properties, if you had tax deferred properties, it's going to get distributed. It'll become a taxable consequence to you and you lose your retirement money. So there's a lot of headaches along the way for that. There's 3 main, the prohibited transactions falls into 3 categories: a per se transaction, a self-dealing, and a extension of credit. Those 3 kind of triangle make up the prohibited transaction universe. The main thing you want to avoid dealing with is what's called a disqualified person. The way we describe disqualified persons, and you can get really in depth with it, but the simple way to look at it is what they call ascendants or descendants, meaning a person, a parent, a grandparent, a child. Those are people you really need to avoid doing business with. There are rules when dealing with business people if you're more than 51% involved in certain businesses. So there's a lot of criteria involved. It's pretty in-depth, so it's like a much longer conversation, but those are the things you want to be careful about. So that's why we try to encourage our participants to avoid engaging in prohibited transactions.
So here's one idea.
Sorry,
go
Kim,
ahead.
but I just wanted to interject for a second. If anybody is interested in learning more about prohibited transactions specifically, there's a lot of information to take in. Obviously, we're only giving you guys the high level, but we do have a really great white paper on our website that goes into really great detail. Specific people, specific relationships, it'll give you examples, everything that you're looking to learn to avoid doing a prohibited transaction. Like Scott said, that's going to protect the tax advantage status of your account, which is super important. So that's one thing that we like to stress. So if you're interested in learning more about that specifically, we've done webinars on it. That's on our website. But if you're looking for a good read on it, we have a really great white paper on our website. So back to you guys. Thank you.
Thank you.
Thank you, Erica.
So let me ask one other question though on this. I get asked this all the time. What if a person is part of the syndication team and then they want to invest their own IRA in that syndicate? Can they do that?
When you say part, like they have a percentage of the ownership in the syndicated team, it depends on the ownership structure and how much ownership they have. That kind of helps determine the whether or not to be considered a prohibited transaction. Like I said, it's generally there. It kind of, like Erica was alluding to, it kind of gets complicated. So if anybody who's watching is interested, feel free to reach out, and we can kind of, once we get your scenario, we can explain it better, because there's a lot of different ways to look at things like that. But generally, there's like a 50% rule. So if you have more than 50% of the syndication, you would probably be considered a disqualified person and unable to engage because it'd be a prohibited transaction.
And also when you talk about that one prohibited transaction, self-dealing, if you're personally as in not your retirement account. So the retirement account is supposed to benefit you in the long run. If you're trying to immediately benefit from an investment personally, then that would be considered a prohibited transaction. So if you have any type of relationship with the investment where you're personally, as in outside of your retirement account, personally benefiting from that investment, then that would also be considered a prohibited transaction. So there are tons of gray area, that we could totally get into on another day and discuss for hours about it. But generally speaking, if you have specific questions about that gray area, a perfect person to speak to in that respect would be an ERISA attorney. They obviously know a little bit more about the laws that govern IRAs. So they'd be able to determine whether or not your involvement in an investment or whatever, how that may affect the retirement account specifically, and if you would be eligible or if you would be allowed to invest in that type of opportunity.
Right. And we're not ERISA attorneys, but I would imagine you guys have some relationships with some. Is that, would you?
Yes. Yes, we do.
Yeah. Okay, good. That's good, because I've tried to look for them before and they're hard to find. So
there's not a lot of them, that's for sure.
Yeah, definitely reach out to Next Generation if you need one, because I've looked and I've had a hard time finding them myself. Okay, well that, and just to kind of go back to your point, Erica, this is where I think most of the syndicators end up not being able to invest in their own deals, is because we talked about that structure where they might be the syndicators might be keeping 30% of the ownership of the company for themselves. So that means they're entitled to, some share of profits, for ostensibly 30%. And that would be outside of whatever cash investment they had made. And I think that's where the issues arise for the syndicators trying to invest in their own deals, because you'd have to almost forego all of that other income in order to be able, and then what's the point? You may as well have just invested in somebody else's deal. Okay, so what does the process look like if someone's interested in investing in a private placement through a self-directed IRA?
Well, actually, again, you alluded to a lot with the subscription agreement, the private placement memorandum. Those are the documents that we require to take a look at for the review process. So when our transaction team takes a look at that, they'll make that determination on whether or not they feel it's a suitable investment moving forward. And that's how that's kind of how the process would work. A lot of our business is referral-based business, and we get people who've worked with us before, so they're familiar with our process. But people who are not familiar with our process, when they come to us, I think we do a pretty good job of educating them on the steps throughout the process, so they feel comfortable with it and they understand how it's going to work, whether it's, like I alluded to before, the timeline, opening an account to making the investment, or addressing any questions or providing customer service once they're on board. So that's what we just do our diligence. We have a lot of experience. We've been in business for over nearly 20 years. And Jamie Raskalinich, who is our CEO, completely understands the business. She's been a pioneer in the SDIRA business. So it's really great to have her on board as a resource for us.
So do you guys ever turn down an offering package if somebody submits it and you think it's not really up to snuff?
Well, again, the transaction department looks at that. Yeah, I mean, we don't want anybody to engage in a prohibited transaction. Like, it just doesn't behoove us to bring someone on board where we can't go through on their investment. It doesn't do us any good. As the custodian, remember, we're not fiduciaries, so I guess our primary role is to provide education. Yeah. And that's why it's important that we look at everything. And I think we do a very good job. We're very thorough, because it's almost, someone made the connection almost to like OSHA and like workplace injuries. Like, we don't want to have any PTs on our calendar for a long time. So we're very diligent at what we're looking for. So if it doesn't look like it's something that's going to pass the smell test, we'll probably pass on it.
Yeah, and that's great that the investors that are working through you guys can have that second set of eyes. But I don't think that's a substitute for getting proper legal advice and accounting advice. I think you'd agree with that, right?
Oh, absolutely. And that's why I worked on retirement services, so I make sure I let everybody know we're not fiduciaries, and I'll get questions that theoretically I can answer, but that's not where we are. That's not who we are as custodians. So I just refer or defer to all the experts like you and ERISA attorneys and accountants.
Yeah.
As does the team I'm part of. Yeah.
All right, and then a really quick just clarification on like our compliance procedures. We're not so much telling an investor whether they can or cannot invest in it, rather whether we as a custodian can hold that investment for them. So it becomes an issue of, is it administratively feasible? Meaning, are we upholding that standard of protecting the tax advantage status? Because when you're reviewing a document, if you see something that might constitute a prohibited transaction, that red flag is going to go up, and then we're going to say, hey, we found something here that doesn't look right, can you confirm, whatever it may be. And then if we determine that whatever it was that we found would constitute a prohibited transaction, we would then tell that client we cannot hold that investment. That doesn't mean that individual cannot go and invest, outside of a retirement account personally. Just that by nature of the IRA itself, we as a custodian can't hold that investment, because it's not it wouldn't put that client in a position to maintain that tax advantage status.
Right. And I think you mentioned that earlier on, but I think it is an important point to drive home, Scott, is that if you do something that's in violation of the self-directed IRA rules, then you could lose that tax advantage status. Is it just for the money that's in this investment, or is it for all of your IRA?
That it would be, it's funny. It's kind of a gray area, but it's specific. It seems, and when I say it's a gray area, we're getting our information from the ERISA attorneys, but it appears that it's generally just this investment. But again, it's like a gray area, and it's interpretational. So, and as an attorney, it depends on how they interpret it. But it could just be a portion. I mean, the prevailing wisdom was that you would lose everything. You'd lose the whole IRA would be infected. But now I believe it could be, and again, it's like in the quotes, could be, and this is more from the legalese, considered just the portion that, was invested in the prohibited transaction.
Right. Well, but it could also open the door so that your entire IRA account gets audited, or you
Right.
get audited. Right.
Right.
So
And,
once you let the IRS in, they don't tend to leave until they get something.
A prohibited transaction has taken place and that prohibited transaction cannot be corrected, the entire account needs to be distributed. So
Oh, wow.
if that is the case and we have to go back and distribute that account, any other investments that are held within that account would need to be distributed personally as well. So
Wow.
sometimes our clients will open up multiple accounts for each of their investments, where if a prohibited transaction were to take place, their other accounts are then protected. If you're pulling together all of your investments into a single account and a prohibited transaction takes place that cannot be corrected, every single one of those assets within that account, because the entire IRA needs to be distributed, then it would in that case include those investments as well.
Interesting. All right. So what kind of forms are required if someone wants to invest in a private placement?
Oh, well, you're gonna start with the bi-direction letter. As you said, the private placement memorandum. We're gonna need obviously wire instructions to get the money in. A private placement instruction letter is also required. You alluded to the subscription agreement, which we also need. A certificate of good standing is also required. So these are all, the documentation that our transaction team will request from the person who's opening an account and whoever's doing the investment.
Very good. Wow, well, that answers all my questions. Do we have any questions from the audience?
Let me check. Okay. Oh, we've got quite a few. Let me go through these really quickly just to see which we can address first. So this is a quick and easy one, Kim. Tom would like you to reiterate the name of your book.
It's called How to Legally Raise Private Money.
Okay, thank you.
Thank you.
Our next question is, give an idea of your fees and your speed with which you process SDIRAs and transactions. So Scott, that's probably going to be a question for you.
Well, the fees are kind of dependent by the amount of money that you're using to open up your IRA or transferring over. We have two options on our fee schedule. We have a flat rate fee, and we also have a fee based on the asset, the amount of the asset. I'd be happy to discuss them, offline without knowing, how much money you're talking about. So feel free to reach out, and I could provide you with the fee schedule. We're very transparent with our fee schedule. There's just a lot of supposition here. So without knowing the exact amount, there's no need for me to get into it.
So as a good attorney would always say, it depends.
Okay. So what investments do you allow in a Roth SDIRA? So Scott, can you explain that as well?
Well, any investment that can go into a traditional IRA can also go into a Roth IRA. When investing, I guess using a self-directed IRA, if that's the question, you can invest pretty much anything can be invested. we say life insurance and collectibles are the main things that cannot go in. So that's usually the easier way to address it. We talked about real estate today. Obviously Lisa's Kim is a real estate syndication attorney. We talked about private placements, hedge funds, cryptocurrency, precious metals. It really goes on and on. But there's no the distinction between a Roth IRA and traditional IRA from an investment purpose is not different. It's just the type of money that goes into that vehicle, pre-tax and after tax.
But you can invest in crypto?
Yes, we could do crypto.
Yeah, I actually had that question come up today, and I said, I don't know. So now I know.
And as Erica alluded to, if you also, I guess a plug for us, and Erica alluded to it, on our website, we have a number of white papers and blog posts, et cetera, in addition to other webinars where you can see what investments we have available.
Okay. So this may be a question for Kim, do certain private placements permit you to get 100% deduction in the year you invest?
That's a question for a CPA.
Okay. So in that case, Tom, that question you would want to direct to either a CPA, tax advisor, tax attorney, et cetera, et cetera. Unfortunately, from our perspective, since we're not providing any, tax advice, that's not a question we'd be able to answer. So if you have a tax advisor, I would recommend going there. Next. I know we've touched on this in some of our previous webinars. I'm not sure if it's relevant here, but Kim, you might be able to provide a little bit of insight on whether or not like UBIT would apply in certain investments specific to private placements.
So it typically does. It applies to the portion of, this is my understanding. Again, this is a question for a CPA or a tax attorney, but it's my understanding that it does apply to the leveraged portion of the investment. So if somebody gets a loan on a multifamily property for 70% of the purchase price, then it's possible that that 70%, the portion of that that's attributable to your investment could be subject to the UBIT.
Okay. And the specific question from Lev was, can you recommend ways to reduce or eliminate UBIT? I don't know, Kim, if that's something that you can personally comment on. I know from us, it's not something that we can comment on. Obviously, we can explain, what UBIT is. But in terms of ways to avoid it, that's probably more of a question for a CPA or a tax advisor.
It really is. And, it may be that you have to invest in unleveraged assets, but, that's going to limit you to the type of assets you could invest in significantly.
Okay. And then finally, let's see. Let's see if I can break this down. Can you give an example of an investment that you would not hold as a custodian, excepting those that are prohibited, except those that are prohibited transactions? So I think, Scott, you mentioned this before. If it's not related to a prohibited transaction, you can't invest in life insurance and collectibles.
Yeah, that's the easy answer. I mean, yeah, life insurance and collectibles, like if to expand on collectibles like alcohol, oriental rugs, yeah, things like that. But yeah, almost anything else, there's a lot to do, and that's why I referenced the website. I mean, you can loan money using, you can do a hard money lending through your self-directed IRA. You can invest in mineral rights. You can invest in medical office buildings. So there are a lot of opportunities, but it's easier to just say you can't do insurance, you can't do collectibles. I mean, there's probably a few other things you can't do, but those are the obvious ones.
You could invest in startups or other small businesses, non-real estate, right?
Yes.
As long as they're private, yes.
Yep.
No public assets. I mean, actually, that's a better thing. I should just say no public assets. These are alternative assets, non-public assets.
So you can't use a self-directed IRA to go invest in a publicly traded company?
Correct. You can't buy Tesla or Apple or whatever.
Okay. I didn't know that.
We don't hold publicly traded assets. Or we can't transact. I should better say we can't transact publicly traded assets.
Okay.
Okay, that wraps everything up. I know we have some time left, so I wanted to get some of these polls out while we still have everyone here. Obviously with these polls, we just want to get to know you guys a little bit better and see what you're interested in. So the first of our polls, we have what types of retirement accounts do you currently have? So I'm going to launch that up, give everyone a couple of seconds, a minute or two to respond. It's not mandatory, feel free, you can forego, but we're really just looking to see, what it is that you guys are interested in and where your current standings may lie. I'll give you guys a few more seconds. All right, so it looks like the majority either have a traditional or a Roth IRA, a SEP or a simple IRA, or some sort of employer-sponsored plan like a 401k, a 403b, or a pension. Not a lot for solo Ks or others. And what a lot of people don't know is that you can actually self-direct an HSA or an ESA, which is a health savings account, or an education savings account. So if that's something that you guys are interested in, we've got more information about that on our website. So to move on, we've got our next poll. What types of investments are you guys currently interested in? So we've got real estate, private equity, which is a little bit of what we kind of talked about today, private placements, lending, cryptocurrency and precious metals, impact investing, and social causes.
Hey, while we're waiting, here's a question. Can somebody use their self-directed account to invest in a nonprofit?
Yes, as long as it's privately held.
Interesting.
And that's kind of where the impact investing and social causes come in. Some people are very passionate about certain movements. So if there's an opportunity for them to get involved as an investor within anything that they are passionate about, then that's an option for them as well. Kind of one of the unique asset classes that we've come across recently is Broadway shows. I know not so much recently, obviously given COVID, there haven't been a lot of Broadway shows, but Broadway shows, off-Broadway shows, off-Broadway shows, in certain instances, they will look for outside investors to fund those productions. Okay, I'll close this one out. It looks like the majority real estate and private equity, which is a majority of the assets that we hold, so no surprise there. And finally, last but not least, and this is something that you absolutely don't have to answer if you're not comfortable, but we just like to kind of gauge obviously where you guys are at. So what is the current balance of your retirement accounts or accounts? So cumulative. I'll launch that one out now. And this is also a good exercise for us to kind of, and not us, but more so, you guys to assess, your retirement readiness. Obviously, if you're nearing retirement age, you may want to consider how you're saving for retirement, and a self-directed IRA is a great way to make that happen. I'll give you guys a couple more seconds. All right. And we've got 50-50 between 50K and 250K and 250K and 500K. So definitely some good retirement savings there, as long as we're not anywhere close to zero. So with that being said, I want to thank everybody for joining today. Kim, thank you for coming on the panel, being our co-host and offering your expertise. As always, Scott, thank you for joining. And for everyone that came to watch what was going on, I appreciate it, and we'll see you next time.
Thank you, Kim.
Bye. Thank you, Scott. Thank you, Erica.
Now, talk to you soon.